I'm sort of bearish on the stock market. It's sort of crazy and weird to see at the same time as I'm bullish on the real economy, which again feels very weird and leads to a long answer instead of a short answer. But that's sort of where I see the economy tying to the oil market, and where I see again, you could see a stock market crash would have a negative wealth effect for the wealthiest people. And at the same time, you could actually see inventory restocking, construction activity pick up, especially for sort of lower to mid end single family homes, and sort of a real economy boom. And maybe the precedent for that is sort of the market in the 2000s, which
Josh Young, thank you so much for coming on the show, my friend.
yeah, thanks for having me on.
Hey, Josh, let's just dive right in. What is your economic overview? What is your 95,000 foot view of the economy at the moment?
Oh man, honestly, no one really knows. It's sort of been this confusing thing. We put out a couple white papers last year about how people were sort of overblowing these recession concerns, particularly for oil and gas. But it's been this weird situation for the last couple of years where economic data has been pretty unreliable. And, there were early indicators that were hit, I think in even like 2021, where you would just, where the yield curve inverted, and where, there were various indicators of slowing economic activity. And so I think we've sort of been, at least from a US perspective, in a rolling recession for the last 2 years. I don't know, plus or minus a little. And I know it sounds weird because the economic growth data, the GDP data, is very positive, but when you dig in, a lot of that is government stimulus related. A lot of that is sort of very low productivity economic activity. And so if you try to sort of normalize it and undistort some of the government data. So anyway, I think it's sort of a weird situation. China is also a weird situation where at least people more broadly accept that you can't trust the economic data. But unfortunately, we're sort of headed that direction here. And then Europe is also. So it's sort of this weird situation globally where nothing's really working how it should economically. And I guess I'll just say, I think that's really promising for oil and gas as well as for the global economy, because if you're in a boom time, then everyone sort of knows you're booming, and this, stock market's up, but the economy, I don't think there's almost anyone that thinks the economy is booming. And so if you're in a boom time, like, you got to worry about, I think, your downside when things are not so great, and you can look around and most people say, hey, the economy's not so good. I think that's actually a time to start looking ahead. And we see this in the freight data where there's like some green shoots, and you see it in some other stuff. And the pushback I get, I use social media probably too much, which is really helpful for weighing sentiment. And you say something positive about freight, or, hey, like, maybe there's going to be inventory restocking, and just get tons of hate. And that tells you, hey, maybe there's actually some possible upside to the economy from here. But right now, I think things are sort of pretty bad and different from what the headlines said.
Yeah. Well, I got a little trigger happy at the beginning, Josh. I forgot to mention that this was your maiden voyage on the show. So as it is with every first time guest, I've got to ask you what your origin story is. Who is Josh Young?
Okay, so I'll do the 30-second version. From Los Angeles, went to University of Chicago and studied economics, did management consulting, worked in private equity, worked for a multi-billion-dollar family office, launched a small long-short hedge fund after never shorting stocks before. That blew up and was terrible, and I should never short stocks again. And we launched Bison in 2015 on the back of some of the successful stuff I had done while running a hedge fund, which was the sort of one-off special situation, mostly public equity investments in the oil and gas space. And so with a business partner, we co-founded Bison in 2015, and we invest in publicly traded oil and gas stocks. We don't short stocks. We run sort of a Buffett style private partnership. And since we started in 2015, we're up about 100% net versus small cap oil and gas stocks, which is our benchmark, down about 55 or 60%. net, you can invest via PSE or something like that. And just disclosure, like none of this is a solicitation or recommendation, and you should always check the details on all of this stuff and consult an advisor. But that's the background. That's what I do, who we are, and we've been running Bison now for getting close to 10 years. So it's pretty cool to have outperformed over that amount of time, and also sort of amazing that oil and gas is really not that much more popular than it was in 2015 when we launched as the Bison, facing into the storm of hatred towards public equities in oil and gas.
Cool. Well, what is the story with oil and gas right now? It's at $83. We've been kind of trading in this $70 to $80 zone for a while. What's going on with oil and gas? Aren't we in driving season right now in the summer here in the United States? Shouldn't we see an uptick in oil and gas prices?
Yeah, I mean, there's like a lot of different aspects to it. So let's say very high level, China isn't quite growing as much as people would have thought. They actually surprised to the upside last year. And then, there's some catch up, I think, in terms of, they maybe consumed a little more oil than expected last year and now a little less now. In the US, we're seeing sort of continued effects of work from home, as well as some of that weirdness in the economy that I was talking about at the beginning. You definitely see weaker gasoline and diesel consumption than you would have thought, but higher jet fuel consumption. And so, yeah, there's a lot of weirdness in the US, a lot of weirdness in China. Europe has been terrible for a long time. Frankly, socialist policies fail, and European sort of centralized planning nonsense is just sort of they're in many, many years into this sort of morass, and unsurprisingly, that's poor for oil demand. And then emerging markets are sort of promising ex-China, and I think that makes up for a lot of this weakness. And again, it's sort of exciting because to the extent that these things resolve to the upside, where you're starting to see that with inventory restocking and some green shoots on freight, and potentially some economic stimulus after years of this sort of morass, regardless of who wins the U.S. presidential election in November. On the back of that, I think you could actually see sort of a real rebound. But in the meantime, we're sort of stuck, like you noted in this. We've been stuck in this price range. And I guess just the last thing, shale has been more productive. Shale has been the real driver for this oil bear market for the last decade or so. And the oil bull market that we saw that started in 2022 was sort of on the back of shale growth slowing or stopping. And shale had contributed roughly 1 million barrels a day of production growth every year from 2014 until 2020. And once that slowed or stopped, which it stopped in 2020 briefly, that allowed oil prices to go way higher. Now that shale has sort of rebounded, and shale productivity, even with low rig counts, you've seen shale production hang in there. That's really kept oil prices range bound. And I think the consensus is that it'll stay range bound. My take is that the well productivity improvements that we've seen are not like what we saw in 2014. There's not some big discovery of a new shale field, and there's not really a big, at least a material size shale field, and there's not really a big improvement in well productivity, like a big step change. And so I think as the per foot productivity falls, despite overall productivity staying high, because are drilling longer wells that are less productive per foot, but if you drill more feet, then you get sort of a similar amount of production. As that plays out, I think you end up seeing production disappoint, but it hasn't happened yet. So anyway, sort of long story short, it's been sort of disappointing for the bulls, disappointing for the bears. I think there's green shoots for the economy, and I think shale may roll over. But again, I've sort of been saying that for a little while, and it hasn't happened so far.
So regardless of what happens in the election, let's say if Trump wins or if Biden wins, what does your forecast for the next 12 months change substantially or not?
I mean, I think there's different economic effects from each of these potential presidents. I think Trump is much more sort of libertarian, and so I think you would see more of a sort of true economic rebound and sort of private sector rebound, as you'd expect deregulation and lower taxes, similar to what happened in 2016. But I think you'd also see, or in the aftermath of the 2016 election, but I think you'd also see an expectation of more rigs getting put to work. So it's probably good for OFS, probably bad or neutral for, it's probably neutral for oil, just because the increased economic activity versus increased production sort of gets offset by each other. And then probably negative for natural gas, just because the increased activity would be most directly linked to an oversupply of local natural gas production. And even with extra LNG facilities getting built and so on, I think you just would see probably more of a glut for natural gas. So that's sort of what I think you'd see under a Trump administration. Under Biden, you'd probably see, especially in the second term, if you look at what happened with Obama in the second term, and you say, hey, similar sort of economic advisors and policy approach, I think you'd see a big step up in regulatory activity, and that would probably be pretty negative for economic activity. You probably see more inflation. It's probably bad for oil demand, neutral to maybe bad for natural gas demand, but also with less activity, probably higher prices. So sort of a stagflationary type situation, which again, we didn't really see in 2012 to 2016, partly because you saw an oil price crash because of that improvement in shale productivity and a gas price crash. Without that productivity miracle, I think you see sort of a more stagflationary type environment, and probably good for oil prices and gas prices, but not super fun. And between the two, economically, I think the sort of deregulation and true economic growth is probably more promising for investments in the space as well as for the overall U.S. economy.
Right. So how much real estate in your mind do you give to whatever the Fed is doing, the Fed funds rate? Has the Fed funds rate made any material change in what the oil price could have been sitting at 5.5%?
Yeah, a little. I think they, I mean, I'm sort of with Milton Friedman on this. I think the Fed sort of causes more harm than good. And I think this sort of approach of, I think there's a central planning sort of hubris. And there's this tendency of people that are, once they have power, to keep it at all costs and then to exercise it. And it's sort of a hard thing. It's similar to money, right? When you have money, you want to spend it, you want to invest it. The hardest thing is to not. And so, similar thing with central planners, whether they're Fed policymakers or presidents or Congress people. And so, I think they have this tendency to shift way too fast to really low rates and then way too fast to really high rates and sort of jerk around the economy. And you can see the negative impact of high rates on real estate and construction activity. And it's really unfortunate because there's a long run sort of shortage of housing. There's just not enough single family homes that have been built or are being built. And there's sort of actually probably too many multifamily or too many apartments built and not enough houses in the last decade. And I think we were sort of resolving that, where you were seeing this next wave of single family homes getting built. And this increase in rates sort of killed that to some extent. And so it's hurting oil prices because it's hurting oil demand, because real estate construction is a really big demand driver in the US. It doesn't really fit neatly. There's some diesel demand from it. There's some gasoline demand. There's some sort of NGL demand for the chemical stuff going into, let's say, pipes or various other things. But I think that's the real impact, and you're seeing it more in real estate, where there's just absolute evisceration of values on commercial at first, and then you're seeing some multifam, apartment complexes and so on getting sort of foreclosed on, and investors there sort of starting to feel pain. And there's a risk that you see that come into single family homes as well. And that's really where I think you see the impact to oil is from this impact on real estate. For actual oil markets themselves, or the oil producers, it's been really weird and interesting, and I think promising, where the credit spreads have been very, very narrow. And so what that means is, historically, when rates would rise, the rates that oil companies had to pay would actually rise a lot more, because it would be indicative of additional risk to demand. People get worried when interest rates rise, so they think, hey, the economy is going to slow, so we don't want to invest in oil. Oil stocks crash and bond yields blow out. Well, actually, this time it's played out the other way around, where you've seen the spread between that 5.5% or various other sort of, whether it's LIBOR or SOFR or whatever other metric you're using or benchmark you're using, the spreads to that have actually been very narrow, and you've seen companies that have very poor performing stocks, including one that I own that refied their debt recently at rates that are sort of nonsensically low, especially in this environment where people are sort of worried about rates rising. I mean, I own Vital Energy stock. I'm not recommending it here or anything, but hey, they just priced their high yield. I can't remember if it was a 5-year or 7-year deal at like a 300-point spread. They priced it under 8% interest, with where they termed out almost all of their debt at below 8% interest. And so, the stock is down, but the bonds have done amazingly well. So one of those is right. And I think that's relevant from an interest rate impact perspective, because if the Fed was trying to slow oil drilling, they're certainly not doing that because there's so much credit availability, but they are hurting the real economy, and they're causing a shortage in single family homes where there already was a shortage, but it's getting worse. And so I think this is going to backfire horrifically. And you don't have to listen to me. You can go back to listen to these old recordings of Milton Friedman, Nobel Prize winning economist, founder of the Chicago School of Economics, sort of arguably one of the most brilliant economists ever. I think you can just listen to him, and what he said about the Fed in the 70s, I think actually holds true for the Fed today.
That's an interesting tie-in that you brought up about the oil market and the real estate market. Personally speaking, I'm of the opinion that we still have some decent runway in the real estate market. Just looking at the new home builds, new home starts over time, we're still below the average there, or just at the average after being under it for over a decade. So what should be on the radar screen for someone that's looking at the real estate market, someone that's looking at the oil market? What are some of the warning signs? Does the oil market respond to a crashing real estate market by coming down as well, because demand for real estate comes down with it, and then vice versa when it goes up? Essentially, are they correlated in that kind of way? So when one moves in one direction, the other moves in tandem with it.
It's a great question. They are, but there's some lag. And so I think what's happened is that we've already seen construction activity fall pretty dramatically. And so not just for single family homes, which, there had been growth in that activity, and that activity now it looks like has either flattened or actually come down. But the activity for commercial, industrial is sort of complicated, but for commercial and multifamily, that activity is down a lot. And so when that activity is down, you've already felt that impact in the oil market, because you already have less diesel from the sort of truck deliveries and whatever. You already have less gasoline from, the construction guys driving their F-150s or whatever to their construction sites, and the various tradesmen and women not showing up. And then you're also seeing it in terms of orders, where people were ordering their like vinyl windows or whatever other oil product related stuff a year ago, and they're delivered, and now they're not ordering as much, so it's not using as much chemicals that are all there already. And so you've already sort of seen there's like a year ahead or 6 month ahead or 2 year ahead type impact. And so that's where it's correlated, but it's where I get back to that initial comment on the economy, where it's in this sort of weird rolling recession environment, you can actually get this sort of thing where it's correlated, right? Real estate construction, real estate prices affect oil demand and affect the oil market in the US, but not necessarily at the same time. And so as you see these green shoots for inventory and green shoots for freight, it's possible that you actually end up seeing some pickup in economic activity. I would think of sort of 2009, 2010. I remember listening to this brilliant investor. He was the head of a large family office in Los Angeles, not the one I was working at, but another one. I still remember listening to him. I think it was late 2009. And he pointed to inventory restocking, and everyone was shocked because everyone was just expecting, all the speakers at the time, everyone was so negative about the economy and negative about the market. He was very bullish, and he just bought a lot of stocks for, and had the family office get very long number of things. They were looking at real estate, but they hadn't and bought that much then yet, but they were getting really bullish stocks. And he pointed to inventory restocking, and it felt very weird because it was the middle of this financial crisis, and finally it had gone from the stock market to the real economy, and people were getting laid off, and you couldn't buy a house, and houses were getting foreclosed on. It was terrible in the real economy, finally, after the stock market crashed the year before. And here he was saying green shoots and go buy stocks and so on. And again, today it's different because the stock market's up, but the real economy is really suffering, and you have these potential green shoots in the real economy. And again, it could be weird, right? Where you have the stock market with these Mag 7 or whatever, some of these companies are very tenuous and they're doing these big deals with each other. The craziest thing I saw, actually, which is sort of funny because I've been active on Twitter or X a lot, is apparently Tesla bought NVIDIA chips and delivered them and paid for them and then delivered them to XAI, and which it's unclear if that's part of X or if its own new company or something, but it's almost certainly not Tesla. And so it's sort of unclear, will Tesla be reimbursed or not, or what's the deal there. But very weird sort of insider deals between these largest companies with these very, very high stock prices and rising valuations for, in some cases, cyclicals, right? Semiconductor stocks are similar to oil and gas. They're very historically cyclical, and you're at a point where the stocks are up a lot, but the multiples are up a lot and the revenue's up a lot. And generally what you see at the top of cycles is low multiples for cyclicals, not high multiples. And so anyway, I'm sort of bearish on the stock market. It's sort of crazy and weird to see at the same time as I'm bullish on the real economy, which again feels very weird and leads to a long answer instead of a short answer. But that's sort of where I see the economy tying to the oil market, and where I see, again, you could see a stock market crash would have a negative wealth effect for the wealthiest people. And at the same time, you'd actually see inventory restocking, construction activity pick up, especially for sort of lower to mid-end single family homes, and sort of a real economy boom. And maybe the precedent for that is sort of the market in the 2000s, which I think is why people reference that so much. You think about just how much pain there was among the wealthiest people in, let's say, 2003, and how amazing it was to own oil stocks or real estate or financials in 2003. And again, there was a little bit of pain for those stocks in, let's say, 2002, but it's possible we're already sort of feeling that or experiencing that now, sort of ahead of time, and that might be a way that this is different from that parallel. But I think there's room for sort of the market and real economy to actually flip again in terms of leadership, where you have the real economy do well, which drives oil prices up and oil demand up, while at the same time you actually have some real financial market risk because of the lack of breadth and the concentration in these few companies that are all sort of doing deals with each other on the back of some hype around new technologies and what looks like maybe closer to a peak for those particular cycles, whether it's semiconductors or software or whatever. And then without that recognition, the sort of view that, oh, these things are not cyclical anymore. I used to, for a while, have this thing on the bottom of my monitor that said, "This time is not different." And so, I think it's sort of a good way to think about this. And so, anyway, that's how I see the economy and oil prices and real estate and oil tying together.
Okay, so 2000 is kind of like your precedent, so to speak, to what's happening today. May not be an exact copy, but is it what you would say the closest thing to what we're currently experiencing?
I think it's the closest recent thing. I think there's similarities to the 70s. There's similarities to the 40s. There's similarities to various other countries in different time frames. I don't know exactly. And again, this time is not different, but it's also not the same. And so, I think it's complicated. And I think it does help to look back. And I was just trying to frame it in terms of, the most recent time that people are pretty familiar with. And sort of the interplay between a weak stock market and a strong real economy, and then sort of the interplay between mistakes on interest rates with the real economy.
Gotcha. So, Josh, what is the latest with the SPR? A lot of people tend to blame the suppressed oil prices on SPR releases. How much impact has the SPR releases had on the oil price being where it is? And then also, what's happening, as far as you know, in terms of what's happening now with the SPR releases? And what does that mean for oil prices moving forward?
Yeah, so I was chatting with a friend who's pretty good at oil futures and sort of understanding the interplay between that futures market and the physical market, which it's something I follow, but it's really helpful to have friends that sort of know these things better. And it's important. I think when I evaluate oil companies too, I try to find like really good geologists or engineers or whomever that actually knows the thing, right? It's way better than like think. I think it's a real advantage we've had at Bison is actually not trying to pretend like we know the thing. Try to just find the people that know the thing.
Nice.
So this friend that really understands sort of this market dynamic and this sort of interplay between the physical and the futures, he was pointing to promising time spreads today as sort of an indicator of potentially much higher oil prices coming soon. And I pushed back and said, hey, there were promising time spreads, which is sort of it's the shape of the curve where when you have backwardation in oil prices, so $83 oil today, but the oil curve shows if you try to sell oil forward a year from now in the futures market, it's like 73. So that sort of large difference is an indication that it's called a time spread. And the shape of the curve is backwardation. If it was 83 now and $93 a year from now, that would be called contango, where it'd be shaping up. This is down backwardation. So this shape of backwardation and this movement in backwardation is indicative of a tight oil market because it's basically you're getting paid more for oil right now, which you need to do in order to clear oil out of inventory. And you only do that if you actually need it. If you don't need it, you put it in storage, you get paid for the storage. And so you have a higher price in the future. You think 2020, there was very little current oil price or little current oil demand, but there was more demand expected in the future. So the spot price was low, the forward price, the future price was higher. And so that was contango and it was indicative of a very weak market. So even though the future price is lower than the current price, you'd think that would be bad. It's actually very, very good. And the more that happens to some extent, actually, the more bullish it is to some limit, where when it's too far that direction, it can actually be sort of a contrary indicator. So anyway, the time spreads are improving. The last 3 times that happened, the physical market fell apart for oil. And so it actually looks like the physical market participants are paying much more attention to this than they did historically. And they joke that the world's best oil trader is Joe Biden and Granholm, his energy secretary. And when time spreads went crazy in 2022 around Russia's invasion of Ukraine, where there was a real shortage in the oil market, they dumped a giant amount of oil into the market. And then it was interesting. So that killed it. So that's the tie-in to the SPR. The amount in the SPR fell by about 50%. They refilled a little, but mostly, there's still a large impact. And just to finish that thread, the crash in oil in sort of December of 2022 was Russia dumping their oil ahead of what looked like would be sanctions that would be enforced. It turns out they weren't really. But Russia dumped a bunch of physical oil and then a bunch of physical refined products, mostly diesel and gasoline, in November, December 2022. So that was the next time spreads were promising. And then the time after that, it looked like there were going to be some sanctions on Iran. They started to dump their oil right into the end of September and early October last year, ahead of a large incident that they claimed to not have been involved in, but magically they were physically dumping their oil a month ahead of that. anticipating significant sanctions, which again never really showed up. We've sort of waived those and not enforced them. And again, back to the sort of Joe Biden oil trader thing, choosing to turn a blind eye to an enemy to let them sell their oil, similar to what we did with Russia in order to suppress the oil price ahead of an election. Hey, it's a that's the business of politics, I guess. So anyway, that's the tie-in. SPR had a real big effect at that moment where things looked really, really tight. It arguably was appropriate in the sense that there was a tight market because of a national security event, and it could have spiraled more. It could have been way worse. Fortunately, that conflict has stayed relatively contained in Ukraine. And again, it's terrible that Russia invaded and a horrible humanitarian aspect, but fortunately it's there and has not spread to a wider war. The world has seen wider wars that have been horrific, and there's nuclear weapons and all kinds of stuff that could be terrible. So fortunately it's been constrained. And so arguably it was appropriate at that time. The further release after the oil market wasn't tight anymore, after prices had fallen, after time spreads had narrowed, I think is questionable and has sort of made the market very weird, where you'll see real physical demand signs and then you'll see like weird stuff happen in the futures market, and then you'll see, oh, they sold another 100 million barrels from the SPR or something crazy like that. So there's been some manipulation, and again, some of it's justified, some of it's not, and hopefully that was helpful in terms of explaining the tie-in between the physical market and the futures market. And so here we are with a tight, time spreads looking promising. Despite all of these economic issues, you actually see inventory declines globally. You're not seeing really big builds in global inventories, despite weak China, weak US, weak Europe. And again, the bears will say, oh, these things are terrible. And the bulls will say, okay, well, yes, they are terrible. And inventories are declining. So it's actually sort of, I think, promising and helpful to keep these things in mind, be open-minded for the positive and the negative, to try to understand what's actually happening, and then to not be too biased towards a particular thing. So anyway, the SPR has been refilled to some extent, or being refilled. So that positive momentum or that inertia should be helpful for the oil market, because it's sort of a minor inverse effect to what we saw in 2022. And it does matter, at least in the short run, for the oil market. And maybe we see an SPR release later this summer if oil prices go closer to 100, 120, somewhere in that range. Even over 95, I think you'd see some movement towards selling out of the SPR. But anyway, I think the reason it matters and everyone's talking about it so much is the impact of lower oil prices in the 2022 election and the impact of the SPR release on that oil price surge and crash in middle of 2022.
Hey guys, quick pause. Looking for the best gold and silver prices out there? Well, I have scoured all throughout the internet trying to find you guys the best prices, and Miles Franklin does it for me. In my opinion, I haven't really been able to find anything else that compares to their prices. What you really want to do, however, is you want to email them at info@milesfranklin.com, and you want to say that Capital Cosm sent me in the subject line, because if you do that, you'll get their special pricing guide. That's some of the most competitive pricing out there. No commitment necessary. Info@milesfranklin.com, and Capital Cosm sent me in the subject line. And now let's get back to the video. Gotcha. Well, Josh, I want to take the conversation over to strategy now. So how do you play oil? Like, do you look at the oil and gas producers? Do you look at the oil service companies, onshore, offshore? What's kind of like your strategy, like in very broad terms?
So I look at everything in the energy space, and we follow everything. Bison is set up to be focused on publicly traded upstream oil and gas companies, because those were by far the most interesting in 2015 when we launched the firm. And we do have some flexibility. So we have some oil field services exposure right now. And in 2020 and in 2016, we got a lot of midstream exposure because the pipeline stocks sold off, we thought, way more than they should have relative to their particular risk and their appropriate valuations. We've had exposure to refiners intermittently and various other aspects of the sector. Right now, I mean, it's a great question. I think there's some things that are very popular that I mean, historically on social media, I've sort of made a mistake of commenting on stuff that's very popular that people get very upset about. And typically, sometimes I'm right, sometimes I'm wrong, right? No one's right 100% of the time. And hopefully you're not right. Hopefully you're not wrong 100% of the time, or else, people stop listening to you and you lose all your money and you move on. And so, we're not as interested in the offshore services companies. We have some exposure there, but those have become very, very popular. And the popularity and the rise in those share prices, while oil has been sort of weak and while other oil and gas stocks have been pretty weak, has made them less interesting. And that translates on valuation and so on. And certain metrics will look like cheap, but again, getting back to sort of that comment on cyclicals, I think you want to buy cyclicals not necessarily when they look the cheapest, because when they look the cheapest, often that's the market discounting negative activity or negative sort of risk going forward, or sort of the top of the cycle. So we're most interested right here in two areas. One is sort of the mixed oil and gas producers on the small cap side. So not companies that are like 99% oil, which have done very well. And, in some cases are at all-time high share prices, or at the very least multi-year high share prices. And not that interested in the pure play natural gas producers, which also oddly are near their highs on a multi-year basis. And the natural gas producers trade, the pure plays in some cases trade at like 8 times run rate EBITDA or cash flow, which is sort of odd because they the market is pricing in a much higher natural gas price a year from now. And the oil companies, they trade a little bit of a lower multiple, but still the pure play oil companies are trading at pretty high multiples. And then you have these sort of middle of the pack companies, let's say they produce a third oil, a third gas, and a third natural gas liquids, somewhere in that range. Any of the companies sort of in that area, almost all of them traded a large discount to the natural gas producers and to the oil producers. And so it's sort of weird, because if you think that natural gas is going to do well, in some cases you can actually get more upside to natural gas going up through buying one of these middle ground producers on the small side at 2 times EBITDA, on the large side at, let's say, 4 times EBITDA, versus buying a large gas producer at 8 times or a small one at like 6 times. And similar on the oil side, some of the oil stocks are so expensive that you can actually get more oil price leverage, meaning you can get more sort of cheaper cash flow, more cash flow per dollar you spend on these sort of mixed oil and gas producers than you can just buying the stock of a pure play oil producer. So this sort of like the in-betweeners, or sort of, I guess I would call them sort of liquids rich gas producers. That's what people used to sort of say, although that has sort of a connotation of sort of specific companies that are, let's say, 70% gas and 30% NGLs. I'm more interested in sort of this like third, or like 50% oil, 50% gas sort of producer. But these, for various reasons, I think they sort of fall in the middle. And so right now, people like them the least. There's like no one I've seen talking about this phenomenon. And to me, that's very exciting, because people like they aren't even thinking about it. They hate these stocks. And then the one other thing about it is, as natural gas prices have gotten hurt on the front end, right? The spot price of natural gas has been very low. So the pure play gas producers, you have generalists coming in and buying the stocks. You have some specialists owning the stocks, so they like them or whatever. But they're willing to pay a very high multiple of cash flow for that gas production, because they look out and they say, okay, natural gas is $2.50 per MCF today, the day we're talking right now. And a year from now, the forward curve shows $4.25, let's say, or $4. So we'll pay a low multiple at $4.25, but a high multiple at $2.50. The hybrid sort of oil and gas mixed producers, they're trading at 2 or 3 times cash flow. So you don't pay anything for that much higher natural gas price. Same on the oil side, where, if you're buying one of these things, the pure play oil guys might be at 6 times cash flow, but you get the same amount of oil, or maybe even more oil per dollar you spend in a 50-50 oil and gas producer equity, because it's trading at, let's say, 2.5 times instead of 6 times. And so what's happened is, as gas prices have fallen, the cash flow for these sort of in-betweener hybrid producers have fallen. And people are looking at them as if there's this term on social media, shitco, or they say, oh, they're like their margins have fallen, there's asset problems, they have bad management, bad assets, whatever. And again, some of these companies are poorly run sort of across the gamut, whether it's the dry gas producers or mixed or oil producers. I don't think the management quality varies that much across these different mixes, but the valuations have, and the perception, I think, has gone way too extreme. And I have this Barron's thing. My barbecue buddies got it for me. Like there was a Barron's article about Bison a couple of years ago. We were up enormously in 2021, and I think they were doing the interview to try to figure out what happened. I just decided I wanted to talk about ESG and how nonsensical it was, and how bad policy was leading to higher oil prices and higher stock values. But looking back at sort of what contributed to our performance, it was these hated companies. People, they would talk about, oh, they're going to zero. And they straight line the decline in margins from a liquids rich gas producer, from the gas price having fallen. And they'd ignore that the forward curve showed a much higher price. And they'd ignore that it wasn't like the business was going to zero. You just had a fall in margins because of a low spot natural gas or low spot NGL price. And so those companies where people have ultra low expectations, where you get to buy them for pennies on the dollar in terms of replacement cost or at very large discounts relative to their proved reserve values, they're very interesting. And I think there's room. I think we're sort of near a bottom. I mean, I guess you could get worse sentiment wise for these stocks, but when you have a dry gas producer at 8 times cash flow, operating cash flow EBITDA, and you have a liquids rich gas producer or a hybrid producer at 2 times, and they're producing, you can get the same gas for 2 times as you get for 8 times. So you have all that upside. And then you have the same oil as like an oil producer at like 6 times, and you're getting 30% more shares. Plus, you turn $1 of exposure into almost, let's say, 250 of exposure of those other stocks. And I think it sets up. It's very painful while the derating is happening. But to the extent that natural gas prices rise, to the extent that oil prices stay steady or rise, I think you have way more potential on these liquids rich gas producers or sort of, hybrid third producers. So to me, that's the most exciting part of the market by far as I look around sort of generally. And then the one other part is oilfield services. Some smaller oilfield services companies, sort of similar, they've sort of gotten left by the wayside. And that's more sort of specific niches where getting to buy stuff at big discounts to replacement cost with lots of free cash flow. I mean, it's sort of similar to the hybrid oil and gas producers where they're sort of forgotten and left behind, but they're still generating a lot of cash flow. But the specifics there, the individual stocks, it's less of a broad theme other than there's like this basket of companies, and more that the market similarly has sort of forgotten them. Some of it's passive flows, some of it's people misinterpreting the specifics of short-term margins and short-term operating performance, and sort of straight line projecting that in the future rather than understanding the specifics of those businesses. But those are sort of the 2 areas I'm most focused on. And that's where I think by far there's the most opportunity in the market here.
So Josh, what I've been doing the last several episodes is I'm letting the guest ask the next guest a question. So I'm going to pose this question of questions to you. If there's one thing you could ask the next guest, what would it be?
I'm interested in where other people are finding opportunity in the market. I think it's really interesting. I think it's a really helpful view into their view on the economy, their view on valuations, and their view on sort of where things are going rather than just sort of where they are. And it's always interesting to hear where people are finding opportunity, and you never really know where you're going to find your next idea. Frankly, some investments I've made have been through tons of digging through financials and reading through, hundreds of reports and so on. And some have been a friend asking me about a stock and me being like, I don't like it, but I'll look at it, and then being surprised at, what I find there. And so you never know what you're going to learn from these sorts of things. And like we had chatted about, I really enjoyed one of your recent interviews and the answer to that question. I don't think that was the question that they had been posed by the prior person, but I think it's really helpful and interesting to see sort of where people are finding opportunity in the market.
Yeah, great question. So This is the question that I got from Andy from Fighting Value, who's my last guest. So if you guys haven't seen that episode, be sure to check it out. Link to that is down below. And he wants to know, what are some investments, some investment traits that have made you the most amount of money? What have you changed in your investment approach and style that has made you the most amount of money? And then conversely, what are some things that prevented you from making money the most? Like, what are some bad habits or traits that you have gotten rid of to really push your returns?
So the best the best investments I've made, I guess it's sort of two things that tie directly into what I'm seeing right now as the best opportunities. So this sort of derating of companies where people sort of use heuristics to characterize businesses as sort of low quality when there's sort of more nuance and when it's maybe more of a macro thing that is inherently temporary. So like these mixed oil and gas producers where the gas price has fallen, so their margins fell, but it's not like they're assets are worse. They just suffered from a short-term crash in natural gas prices and natural gas liquids prices. So I like those a lot. Again, people just sort of turn off their brains, and especially in this sort of passive flow and sort of quant-driven market, there's a really sort of clear path to re-rating on those sorts of things. And so that's sort of where I've done the best. I think the thing that I've done that's been not so great that I'm still working on, and it's been helpful to do less of it, but I probably need to do even less. I'll find companies that are great activist candidates and I'll buy the stock. And you can't actually do that unless you're actually going to change it. Because even if you think, hey, it's going to do okay if I don't change it, there's a reality which is that it's an activist candidate for a reason. And so there's a couple of companies we're actively working on. And so I wouldn't categorize those as that because we're in the process of talking to the board or talking to large shareholders or trying to figure out sort of like what to do exactly. So that those aren't in that category, I think, because we're actually like moving towards an outcome there. There's a couple others. There's one in particular that we own that we sold most of, but it would be a good activist candidate. There's another one that we own that again, I'll sort of, I guess, suffer from this trap where it does seem to be working anyway, not the share price, but the business itself. And so there's some hesitation to make changes there. But owning something that is an activist candidate without actually pursuing activism is a giant mistake. And we'll try not to make it. And it's something that we've done a lot less in the last couple of years than we had done previously. And then I guess just like we have actually had success in activism. It's sort of weird. I was chairman of a public company in Canada for a year and a half, and it was part of the motivation to build a like media following and social media following. Like people didn't really know about it. It had been $1 billion market cap company, and no one cared that I think it was 33 at the time, something like that. That became chairman of this company. Like no one cared, and we started mining Bitcoin using waste gas. Like we had natural gas we were losing money on. So but I went up to Spring, Texas and bought some used Bitcoin miners and mailed them up to Calgary, and we plugged them in, and half the research analysts downgraded the stock or dropped coverage because they claimed they couldn't understand it. This one banker said no one should do this, but if it's anyone, it shouldn't be them. And it was like, okay, well, that's wonderful. No coverage, no whatever. And we actually had a really positive result on that. We got a hostile bid after cleaning up the company, which is sort of we weren't looking to sell it right then, but the idea was, hey, it has this really great asset that's sort of people are confusing, sort of similar to this liquids rich gas sort of strategy now, where people look at these companies and they might have an oil field and a gas field, and each of those could be worth a lot more if it was its own company, but because they're combined, there's sort of this conglomerate significant discount. So there were some producing fields that were mediocre, and then there was this amazing field that was getting no value in the market. And so selling off the producing fields sort of cleaned it up. And there were two private equity backed companies on either side that were acquisitive and backed by large firms that had a lot of money that were looking. It was sort of clear they wanted to own this asset. And so cleaning it up allowed us to get bought. And we ended up selling for a 75% premium to where we were trading, and at a 20% premium to where the stock was trading before I became chairman. And that was great because the average company in that same area, their public equity, the average stock of companies in that area was down about 50% in that time frame. And the average of companies of our size or smaller, those stocks were down an average of actually 70%. So, or 65, somewhere in that sort of enormous down range. So we actually added a lot of value through that. And I'm very thankful we got involved there because there was a lot of risk that could have done as poorly as some of the comps, right? It could have been down another 70% instead of up 20%. And again, getting back to the mistakes we've made, one of the biggest ones is buying a stock that is an activist candidate and not trying to make changes. So trying to not do that again. It's a really good question. I think everyone has their sort of own faults and own issues in their processes. And that's been one for Bison. And it's something that we're working on, that we have a lot less exposure to than we did historically. And hopefully we'll resolve it partly through some of the activism we're working on right now, as well as through owning stocks of companies that are, our mantra when we were launching was survivable balance sheets, good assets, cash flowing assets, and good management teams. And so where you wave on one of those, you can get into trouble. And we do try to find those, and sometimes you get surprised to the downside by people or assets, or sometimes they choose to destroy their balance sheets. But I think it's important to sort of have that discipline and to be proactive one way or another on those sorts of companies.
Nice. Well, I've got to ask you this as well. I've also been asking this to my guests regularly, but I want you to recommend a book or two. What are some books that you recommend that the audience should pick up to really understand the oil market or the markets in general? What do you think?
I've been sort of reading and rereading Mastering the Market Cycle by Howard Marks, the Oaktree guy. And that one's just, it's so interesting. I feel like there's a lot of depth there. There's sort of the superficial, like, everyone sort of read his letters and heard sort of the Oaktree, buy, essentially just like buy when there's blood in the streets, and like, similar to like Seth Klarman's margin of safety. But I actually feel like there's more there where they sort of hint to like how they actually go about underwriting stuff and how they really think about where you're at in a cycle and think about risk and so on. And so that's been a really interesting one recently. And I understand it's not oil specific, but I would argue that understanding the market cycle is very important to understanding oil and gas, as well as underwriting oil and gas equities. And then I think the what is it, a Crude Volatility it's a pretty good one too. Just the understanding the history of oil and gas and sort of how volatile it's been and what the impact is of there being a sort of potential available supply, sort of like OPEC has been for a number of years. And before that, there was sort of the Texas Railroad Commission and their sort of constraints on the oil supply. And before that, there were other sort of similar things. And before that, Standard Oil. And so understanding, I think, the oil market dynamic and price dynamic is really helpful, especially, we think that OPEC is getting towards the limit of their spare capacity. They did significant cuts, so they need to unwind those. But once they unwind them, there's not a lot of evidence that there's more productive capacity beyond what they've restricted in the last couple of years. And so I think understanding what happens when that market gets less controlled in both directions. I think there's sort of this argument for super volatility. There's an argument for a super cycle. And then, getting back to the question on time frame, there's an argument that, and this is not made in that book. I think I'm far more bullish on oil structurally than the author and his firm. But I think there's room for this to end up being like the 1970s, where you go from a less structured market to a more structured market. And I think the equivalent of that is OPEC having had a lot of spare capacity going into a time frame where OPEC, frankly, is less relevant, but also has less or no spare capacity. So as we get into oil demand in the next few years, as oil demand rises more than 1 million barrels a day and supply does not grow by that, especially as shale disappoints, as Guyana grows, but it just offsets some of the other growing or some of the other declining places as Iran sort of gets to their natural limits as well. I think it's sort of a good reminder of what happened in a similar situation, which ironically was around the formation of OPEC, and where there just wasn't as much oil as everyone sort of thought there would be, and this re-rating of price significantly and sort of pushing oil to a point of demand destruction because of the price movement. So I think it's helpful to read that book and sort of think about, hey, how much is the market being controlled today? And so many oil market commenters and analysts and investors think about the downside case, like we saw in 2020, where the oil market fell apart because of lack of coordination and lack of discipline by OPEC. But I think no one or almost no one thinks about this scenario, which we think is actually reasonably likely, that over the next few years, you actually see OPEC not able to supply that incremental demand barrel and to see the price reset to a point where you actually see demand destruction.
Nice. Well, Josh, we will have the link to both of those books down below, guys. So be sure to check them out if you want to partake in some of the knowledge that Josh was putting forth. Josh, where can people find you? Drop us your socials.
Sure. So bisoninterest.com is our firm's website. At Bison Interests on X. You can find us on LinkedIn. You can find me personally on X, Josh_Young_1. And then, again, none of this is investment advice or recommendation or solicitation or anything along those lines. Just fun to have these sorts of conversations. And, I'd suggest that anyone listening to this, if they're found this because of me, they should follow this channel. Danny does some great interviews. And actually I ended up on here because I messaged him about another interview that he did recently that I thought was really well done. So I'd recommend this, and I'm not just saying it. I really genuinely have found a lot of value in these interviews. So thank you, Danny, for having me on.
Yeah, and just for the record, Josh was not compensated for that comment. So thanks, man. I appreciate the kind words. Please, guys, if you enjoy this content, hit that subscribe button. Like the video down below. Like the video as well. Also, comment "Go Josh, go" in the comments if you enjoyed this video. Go Josh, go. And with that said, I will bid you adieu. Until next time, guys. See ya.